Last week, the market decided the Federal Reserve is done cutting rates, and a few are even betting the next move is a hike. But they've got it all wrong, and the reason why is hiding in plain sight. Here's what everyone saw: the Fed held rates, the dot plot penciled in a hike, forward guidance is gone, bond yields jumped. It's an easy story, right? No more cuts. But while everyone looked at the scoreboard, the new Federal Reserve Chair, Kevin Warsh, rebuilt the entire system from the ground up. Five task forces and a complete overhaul of how the Fed actually makes decisions. He stopped telling the market what he plans to do. He wouldn't even submit his own interest rate forecast. And every piece of it clears a path to the same place: lower rates. The market is still pricing in the old Fed. Over the next 10 minutes, I will show you the new Fed, why the next move for rates is down, and what this means for your money and for Bitcoin. Let's begin with what actually happened on June 17th, because the headline read was reasonable. On the surface, this looks hawkish. The Fed held the Fed funds rate at 3.5 to 3.75. The new projections, the famous Fed dot plot, showed that the median official now expects one rate hike this year. The Fed dropped its forward guidance, the language that usually hints where rates are going, and the bond market reacted how you'd probably expect. The 2 year Treasury yield, the part of the curve most sensitive to Fed policy, jumped about 14 basis points in a single day. So the takeaway pretty much wrote itself. Inflation is running hot, the committee is leaning towards a hike, and no interest rate cuts are on the horizon. But if you only looked at the surface level, this is what you'd come away with. And it's not a crazy read. CPI, the Fed's primary measure of inflation so far, is still well above the target rate of 2%, but we will come back to that later in the video. Here's the thing: the market was looking for a rate decision, but Evan Warsh didn't go up there to make a rate decision. He went up there to rewrite the entire playbook. And once you see what he actually did, the hawkish narrative starts to fall apart. Kevin Warsh walked into his first meeting as the new Fed chair and announced five task forces, five separate teams, inside and outside the Fed, tasked with reviewing how the entire institution operates: communications, balance sheet, data the Fed uses to read the economy, productivity and jobs, including artificial intelligence, and five, the inflation framework itself. Sit with that for a second. Communication, balance sheet, data, jobs, and inflation. This is everything, right? This is all aspects of the economy. And the new Fed chair is wiping the slate clean and taking a look from first principles. That's every major lever the Fed pulls, all under review at the same time. No Fed chair in modern history has done something this radical in the first week. He gutted the policy statement. It was shorter and stripped of the typical lawyer HR compliance type speak. He killed forward guidance on purpose, and here's the most interesting part: every member of the committee submits a dot, their personal forecast of where they think the overnight Fed rate will go. Even Warsh refused to submit his own. The chair of the Federal Reserve looked at the most watched global forecast in markets and said, "I'm not participating. I don't want anything to do with this." So, step back. The market spent the day reading the dot plot, the forward guidance, the statement. Warsh spent the day making all three of those signals less meaningful. The market is reading tea leaves that the new Fed chair is throwing out. The question is why, and the answer is in those five task forces, because every single one of them quietly builds the case to cut rates. Allow me to walk you through it, because this is the whole thesis. We'll start with communications. Everyone read no forward guidance is hawkish. The Fed won't promise cuts, so cuts must be off the table. Flip that around. Forward guidance is a promise, boxes you in. If Warsh had guided dovish, the inflation hawks on his committee would have revolted. If he guided hawkish, he couldn't pivot without looking like a liar. So he guided nothing. He kept his hands free, untied. Warsh said it plainly: He wants markets reacting to incoming data, not to what the Fed says. That's not a Fed chair closing the door on cuts. That's a chair keeping the door open so he can walk through it on his own schedule. Now, task force number two, data. And this is the key that unlocks everything. Back in 2023, Jerome Powell described the Fed's problem with one unnerving line. Quote, "We are navigating by the stars under cloudy skies." Translation: Fed steers by data that's lagged, revised, and oftentimes just plain wrong. And Kevin Warsh agrees. He said most of the data central bankers use comes from old survey methods describing an economy that looks nothing like 2026. He called a lot of it, quote, echoes of history. He wants real time data instead. Here's why that matters for cuts. Right now, the official inflation number looks hot, but Kevin Warsh builds a framework that looks at real time private sector data instead of the lagged government number, gets the justification to look straight past a scary headline print. The data task force is a justification engine for easing, and the headline number really is misleading. Take CPI, for example. The official inflation number is one of the most flawed statistics in all of finance. Start with what's actually in the CPI basket. CPI tracks a basket of goods that the government handpicks, and the basket doesn't really match how you spend your money. It underplays the things that dominate your life: rent, groceries, gas, and it pads itself with stuff you rarely buy. And they change what's in the basket over time, so you're not even comparing the same thing year to year. You're quite literally comparing apples to oranges and calling it inflation. Then there's the timing. CPI is built on manual surveys and collected data. By the time it's printed, it's already old. And here's the part almost nobody accounts for: rate changes take months, sometimes more than a year, to ripple through the economy. So today's inflation number is partly reacting to decisions the Fed made a year ago. Sit with that. The Fed is steering a $30 trillion economy with a number that measures the wrong things the wrong way and shows up late. That's the data Kevin Warsh wants to replace, and it's exactly why one hot CPI print is a terrible reason to hold off on interest rate cuts. That's the flawed picture everyone is reacting to. Now, here's what's actually happening underneath, which brings us to the inflation task force. Headline inflation ran about 4.2% in May. It sounds terrible, but core inflation, which strips out food and energy, was around 2.9%. The entire gap between these two numbers is energy, and that energy spike tracks back to one thing: the conflict with Iran and the disruption to the Strait of Hormuz, which moves about one fifth of the world's oil supply. Here's the part the market is glossing over. Core inflation was already cooling before the energy shock hit, and Central Banking 101 says you look through a one time supply shock. You don't hike rates because a war spiked oil. Furthermore, a US Iran framework was just announced. If this holds and energy comes back down, the one thing propping up the scary headline number unwinds on its own. Drip out energy, and the Fed has every excuse that it needs. Next is the productivity task force, and Warsh has argued for years that AI is fundamentally deflationary. More productivity, lower costs, downward pressure on prices, which gives the Fed room to cut. Now, this is the one piece that pulls in two different directions. In the near term, AI is a demand shock. The capex on data centers, chips, and power is enormous. And that adds to growth in prices before the cost savings and productivity gains start showing up. So don't bank on AI being a near term catalyst for rate cuts, but it is a long term tailwind. But it is a long term tailwind, and directionally, Warsh's own worldview points at lower rates. And lastly is the balance sheet task force. And this one looks hawkish at first. Warsh has said for years that he wants to shrink the Fed's balance sheet, and he just launched a task force to do it. But shrinking the balance sheet and cutting rates don't have to contradict. They're two separate levers. You can ease on rates, the price of money, while trimming the balance sheet, the quantity of money. Now, hold one thought because we're going to come back to this. Warsh has also argued for years, like I said, that AI is a powerful deflationary force, and a government sitting on $39 trillion of debt cannot survive deflation. Now, here's where this all leads and why it matters for what you own. Warsh wants to shrink the balance sheet in the near term, but look at the trap that he's in. $39 trillion of debt in an artificial intelligence industry that is going to put massive deflationary forces on the economy. For a normal economy with sound money, falling prices is great, right? Everyone's money becomes worth more. Your purchasing power increases over time instead of decreases. But the most indebted government in history, this is a death sentence. It makes the debt impossible to pay back. Rate cuts will come first, but eventually, the only way to stop a $39 trillion debt that is rapidly growing is to increase the liquidity in the system, the amount of dollars in monetary units. More money and a bigger balance sheet. Warsh calls that an emergency tool, but at some point, the debt will make this certainty. And when governments get backed into printing to manage their debt, there's only one asset built for exactly that moment. Five task forces, five engines, all pointing in the same direction. Now, if all of this is set up, the next part is the tell. This is the single piece of evidence the market is misreading the entire meeting. Stick with me, because once you see this, you cannot unsee it. Remember that hawkish headline, the dot plot shows a rate hike. Let's actually pin that down and take a look. 18 officials submitted their rate forecasts, and headlines screamed 9 of them see a hike happening this year. And that's true, but that means that 9 of them also see rates either staying the same or coming down. The committee was a dead even 9 to 9 split. Quote, hawkish dot plot is actually a coin flip, and the median tipped to a hike by just a single dot. And here's the kicker. Warsh himself described the dots his colleagues submitted as coming in, quote, with pencils, the kind with big erasers. His words, meaning low conviction, ready to change on a dime. Then he refused to add his own dot at all. And he's openly talking about reforming or scrapping the whole forecast. So put the pieces together. The market took a 9 to 9 coin flip that Fed chair himself called low conviction and is trying to retire, and the market reported that as a hawkish hike signal. That's the misread. They're treating a signal as gospel the exact moment the new Fed chair is telling you it barely means anything. And here's the part that takes this from Warsh probably wants to cut to the math basically forces it. The average interest rate on the United States' $39 trillion of debt is about 3.4%. Do the math, and the government is now spending over $1 trillion a year just on interest. Interest alone is eating roughly 14 cents of every dollar that the federal government spends. There's only one lever to pull to slow that down, and it's lower interest rates. Every cut shaves billions off of what the Treasury has to pay to roll over its debt. Warsh has already talked about the Fed and Treasury working more closely and about shifting the Fed towards shorter term debt that lines up with how the Treasury is borrowing. I'm not saying that the Fed will cut to bail out the government, but history tells us they will do whatever they can to avoid total economic catastrophe. Just look at the 2008 bailouts and the 2020 bailouts. Now, let me argue against myself for just a moment and present the Steelman case for the Hawks, because they do have an argument. Inflation is still well above the Fed's target rate, and ghost of 2021 still looms when the Fed called inflation, quote, transitory, looked past it and got burned. Prices in the economy are still at an all time high, and affordability for the average American is at an all time low. If the Fed starts cutting rates prematurely before these deflationary forces are able to take hold, then they could make things much, much worse. Additionally, furthermore, Warsh isn't the sole decider of rate policy. You do have the nine officials that want to hike. So I'm not telling you a cut is guaranteed at the next meeting, but what I am saying is the structure that Warsh is building does point in that direction. He's cleared his hands, no guidance is necessary, and he can make that cut when the moment arises. Furthermore, the inflation spike is mostly energy, and that energy shock may be resolving. So, what does this mean for your money and for Bitcoin? Look at the last time the Fed actually started cutting, September of 2024. Bitcoin was trading around $60,000, and 3 months later, it had run to roughly $108,000. That's an 80% gain in just 1 quarter. And it, of course, did not stop there. From that first cut to the bull market high, Bitcoin doubled. That's what happens when the liquidity tides expand. Risk assets, and Bitcoin most of all, go up. They absorb that liquidity. If Warsh is doing what I think he's doing, then we are early in that same setup. The market is looking at this meeting all wrong. Don't make the same mistake. If you understand the new framework that the Fed is building, then comment Fed down below. I want to see who sees the same thing that I do. I will be tracking every one of these task forces as they report over the coming year, those reports are going to be huge, so make sure you subscribe to the channel so you can follow along.